Most traders think investing is about timing the market, buying at the bottom, selling at the top. But the truth is, that approach is often the fastest way to lose money. Today, we're going to highlight the key concepts from one of the most important investing books ever written, The Intelligent Investor by Benjamin Graham. In this video, we'll break down the most important lessons from the book. Mr. Market, the margin of safety, the difference between investors and speculators, the biggest mistakes traders make. By the end of this video, you'll understand how to think like a long-term, rational investor and make smarter financial decisions. Benjamin Graham wrote this book nearly 80 years ago, yet its lessons are still highly relevant today. He is known as the father of value investing, and his most famous student is Warren Buffett. What makes this book special is not just the strategies, it's the mindset. Instead of promising quick wins, it teaches you how to avoid mistakes, control your emotions, and stay in the market long enough to grow your wealth steadily. Think of the market like a turbulent river. Many people try to surf it blindly and wipe out. Graham teaches us how to build a strong boat, a strategy that keeps you afloat during rough waters and allows you to reach your destination safely. The market is unpredictable. Prices fluctuate constantly. Fear and greed dominate most traders' decisions. Graham's approach isn't about guessing the market. It's about navigating it safely and thinking strategically. Mr. Market, understanding market emotions. Graham asks us to imagine the market as a person, someone he calls Mr. Market. Every day, Mr. Market shows up at your door, offering to buy or sell shares at different prices. Some days he's euphoric and prices rise sharply. Other days, he's fearful and prices fall drastically. The key idea: Mr. Market is there to serve you, not guide you. You don't have to follow his every mood. You can take advantage of it. For example, imagine a stock worth $100. One day, Mr. Market offers it for $80 because he's panicking. That's your buying opportunity. Another day, he offers it for $130 because he's overly confident. You can ignore him. Mr. Market teaches us that prices are emotional, not rational. But emotion alone doesn't protect you. You need a method to manage risk. Margin of safety. Protect yourself. The margin of safety is one of the most important principles in investing. It means never paying more than an asset is worth. Buy below value so that even if things go wrong, your risk is limited. Suppose you calculate a company is worth $100 per share. You buy it at $80. That $20 difference is your safety buffer. This principle protects you against mistakes and unexpected market events. It forces you to prioritize protection over greed. In trading terms, only take trades with favorable risk-reward ratios. Set stop losses to avoid catastrophic losses. Investor versus speculator. Graham draws a sharp distinction between investors and speculators. Investors focus on value, long-term growth, and risk management. Are patient and disciplined. Don't react to daily market noise. Speculators chase short-term gains, react to every market move. Let emotion dictate their decisions. Buying a stock because everyone else is buying? That's speculation. Buying it because it's undervalued with a margin of safety? That's investing. Most people think they're investors, but in reality, many are speculating without realizing it. The biggest mistake: following the crowd. The market punishes herd behavior. When prices rise, people feel safe and buy. When prices fall, fear takes over and they sell. Result: buying high, selling low. The opposite of what Graham teaches. Intelligent investors wait for opportunities when Mr. Market is irrational. Take advantage of others' fear or greed. Remain disciplined and patient. Example: during the 2008 financial crisis, panic prices created opportunities for disciplined investors to buy strong companies at a discount. So how do you apply these lessons in your own investing or trading? Observe. Don't react. Focus on value, not hype. Always consider risk before profit. Use a margin of safety. Know your role. Are you acting as an investor or a speculator? Long-term success comes from discipline, patience, rational thinking, not from chasing quick wins. Investors who bought during market crashes like 1987, 2008, and 2020 often saw massive gains over the next decade because they focused on value and ignored panic. If you take one key lesson from The Intelligent Investor, let it be this: the market is emotional and unpredictable, but you can stay rational and disciplined. Use Mr. Market to your advantage. Protect yourself with a margin of safety. Always know your role as an investor. Long-term wealth is created by thinking strategically, staying patient, and avoiding mistakes. If you enjoyed this video and want to continue learning investing principles from timeless books, make sure to hit the subscribe button and turn on notifications. In the next video, we'll break down another investing book and show you how to turn its lessons into practical strategies you can apply today. Stay with the series, apply these concepts, and gradually, you'll think like a true, intelligent investor.